As we move through life, our responsibilities grow and our families expand. A financial plan from a decade ago rarely accounts for today's milestones. Adapting a life insurance policy or an annuity is a natural response to those changes, ensuring your coverage actually matches your current reality. The tax code even provides a pathway for these updates, called a 1035 exchange. It allows you to transfer values from an outdated contract into a modern, better-performing one without triggering an immediate tax bill. When the consumer's needs drive the decision, replacing a policy is a positive step in maintaining a robust financial safety net. However, every time a contract is turned over, it generates a fresh commission for the producer. That financial incentive creates a specific risk of exploitation. Exploitation takes the form of twisting, using incomplete comparisons to drop a competitor's policy. Then there is churning. This internal replacement erodes existing asset value to fund a new policy within the same company, generating a new agent commission. These tactics are successful because they rely on the authority clients grant their financial producers to guide them through complex decisions. The risk to the consumer is the information vacuum created when trade-offs are hidden. Without transparency, it is impossible for a client to distinguish a beneficial upgrade from a predatory turnover. To bridge that information gap, regulators establish the NAIC Life Insurance and Annuities Replacement Model Regulation. This framework is designed to eliminate the secrecy of a sales pitch by mandating full disclosure at the point of sale. Every application starts with the replacement question. The producer must explicitly identify if the new purchase involves altering or surrendering any existing coverage. If a replacement is identified, the producer must provide signed written notices that outline exactly what the client is sacrificing and what they are gaining. These requirements turn compliance into an active mechanism that forces the producer to justify the transaction in writing. That justification is necessary because a new policy isn't a simple swap. It requires the client to permanently give up established benefits. Established policies have already cleared contestability windows. A new policy resets protections to day one, exposing the family to past risks. You also lose liquidity. A new contract triggers a fresh surrender charge period, locking funds behind a new penalty curve. Even with tax-free transfers, the favorable interest rates or unique riders of the original contract are gone for good once that policy is terminated. For a replacement to be compliant, the producer must demonstrate that the new benefits are significant enough to absorb the total cost of starting over. Oversight doesn't end with a signed form. Carriers maintain ongoing surveillance systems to monitor producer behavior over time. This monitoring includes analyzing replacement ratios. If a producer shows abnormal patterns of turnover, carriers flag those transactions to investigate potential churning. Carriers are also required to keep these records for 5 years and must formally notify the original insurer that their policy is being replaced, allowing for a second layer of review. This automated overwatch ensures that predatory activity is identified within the broader data, maintaining a fair and transparent market. In the final review, a valid replacement should meet a simple, clear metric, the one-sentence rule. If a producer cannot explain the tangible financial benefit to the client in a single, clear sentence, the carrier will reject the application. At its core, a compliant replacement must be a documented improvement of the client's financial position. Let's work together to keep our business honest, transparent, and consumer first.